Welcome, everybody. Glad to see you here. This is Robert with Investing Made Easy. Hey, just wanted to do a quick video and make it public to all who are interested on market manipulation and how the financial markets really work. This video may not take too long, but I do want to show you again how the markets are manipulated. And this video that we're about to watch is an interview that was done in 2006 by a really big market influencer. Some of you may recognize this gentleman's face, his commentary that is on TV just about every single day and has been for a number of years. And so it's not so much to say, hey, this person's bad or whatever the case might be. It's no, this person set himself up to be the fall guy. What you're about to witness here was never meant to go public. It was recorded on a private website of his back in 2006. Don't make no mistake about it. Just because it was recorded back in 2006, it is not out of date whatsoever today. Matter of fact, it's even worse, but done on a larger scale. And what the financial industry does not want you to know is that this stuff happens every single day. And again, this is a side of the market that the big boys and girls, or the banks and institutions, if you will, do not want you to see or be witness to. All right. So with that being said, let's just get right into the video here. But as we do, a few other points of reference. First off, if you've ever seen this person on the news or on TV, going into a show that he's had on TV for 15 or plus years, whatnot, he always tells people never short the market. Shorting the market is a way that we can make money as the market goes down. Matter of fact, he's been quoted in saying shorting the market is un-American, if you will. One of the biggest reasons why is because the financial institution does not get paid unless you keep your money in the account. Therefore, they, in our very biased opinion, they brainwash the general public to only buy and hold, only buy stocks, buy low, sell high, that type of mentality, so on and so forth. But the way that, the things that you're going to witness here in this video will hopefully be a wake-up call to you and more so inspire you and motivate you to take better control of your financial future. So without further ado, let's go ahead and get started. And some of you might have recognized this gentleman here off to my right automatically. Now, again, this was a video that was recorded on Jim Cramer's website, his private website called thestreet.com, again, back in 2006. So just so you know, Jim Cramer got his start in the financial industry by being recruited out of Harvard by Goldman Sachs. He was a stockbroker for a number of years, ran a very successful hedge fund, sold that, and ultimately found his way onto some news channels, and now has had, like I mentioned before, a TV program for quite some time and is a regular commentator on the news. And so not so much that we're poking at Jim Cramer personally, but he is really just explaining in this private interview, again, done on his website back in 2006, how the market really works. And so, again, it's just to make sure that you guys are up to speed on that. So, again, you can take a better control of your money. Now, you can see that this video is 10 minutes and 49 seconds long. We're only going to watch about the first 6, maybe 7 minutes of this. And just heads up, because I'm going to pause it very frequently, not to be annoying, but more so to explain to you what is really going on and what this gentleman is explaining to this interviewer in the white shirt. Now, this gentleman in the white shirt, his name is Aaron. He actually, at the time, worked for Jim Cramer, and I don't know if he still does or not, but he worked for Jim Cramer, and he is interviewing, again, Mr. Cramer on his own website. And so let's get into it without further ado so you can see how the markets really work. But please don't shoot the messenger, being me, Robert with Investing Made Easy. Here we go.
Welcome to Wall Street Confidential. I'm Aaron Task, joined again by Jim Cramer. Jim, welcome.
Good to see you.
Thanks for being here. There's a lot of economic data out today, but I want to talk about something else first. Again, today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the holiday period that we're seeing this?
A lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down.
Okay, I am going to pause it right here. My friends, we are 29 seconds into this video, and what did Mr. Cramer just say? He said, a lot of times when I was short the market, meaning I needed the market down. Now, the reason why I pause it here is because if you pay attention to big news media, the financial industry itself, they're not explaining to you people or the general public how to short the market. Again, that's how money is made in stocks as the market goes down. But also, like I mentioned before, on this gentleman's TV show, he also disclaimers and says you should never short the market. However, just notice what he just said. He says, a lot of times when I was short the market, I needed it to go down. Now, listen to what he says here.
I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher. Maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund game to do it because it's legal,
right?
And it is a very quick way to make money and very satisfying.
Okay.
By the way, no one else in the world would ever admit that, but I can care.
That's right, and you can say that here.
I can't. I'm not going to say it on TV.
Okay, we're going to stop right there. I don't know if you guys caught that last part he said. He says, yeah, but I'm not going to say it on TV. So let me dissect what happened over the last 1 minute and 33 seconds. First off, he says, when I was long. Now, if you don't know what long means, long in the market, it just basically means buy low, sell high. Long just basically means you're bullish in the market and you're looking for the market to go up. So you're going to buy low, sell high. Everybody's familiar with that. Short means you're going to sell it high and buy it low. So the same money that you make if you buy it low and sell it high can be the same type of money that you make if you sell high and buy it back low. But again, that's the side of the market that the big boys and girls or these big banks and institutions do not want you to know about. Now, in the last 93 seconds here, he says, if I were long, he goes, if I were long the market, he would take a bunch of stocks. He would commit $5 to $10 million capital to do it. And what he's doing, my friends, is if you know anything about traditional technical analysis about support and resistance and breakout patterns and indicators and all this other stuff, they know, big banks and institutions know that in order for you, listen closely, because now I'm going to start to question maybe some of your belief systems, and this might be an issue that you need to address in order to attain different results in the financial industry. Only say that because we love you and we want to make sure that you're protected. Now, the banks and institutions know that all of those indicators are a delayed indicator based off of the closing price of the stock. So basically he says, hey, look, if I'm short, what I'm going to do is I'm going to go and I'm going to drive the futures market higher. I'm going to make sure that people see a breakout. I'm going to make sure that a moving average or a MACD or things of this nature are going up. Then they know that the uneducated person who, with all due respect, spends a lot of time and a lot of money, could be days, weeks, months, years, even decades, reading books, watching YouTube videos, and getting the same information that somebody who read a book before you is just regurgitating, if you will. They know that everybody out there on the retail side, by the way, we are known as retail traders and investors. And not only that, but also on the institutional side, they just try to trap each other on the way there. And so just kind of an FYI. The other thing that he said there is he called it a game. I don't know about you, but investing my money in the stock market is not a game to me. And we would highly suggest that it not be a game to you. And so just so you know that is how the big financial institutions view this industry. Now, why is it more a game to them? Well, quite frankly, in my very biased opinion, it's not their money they're investing. It's your money. So yeah, they want to do the best that they can. However, they don't really care. They really don't. And so anyway, he said, so if I'm short the market, what I'll do is I'll move the market up. So he's going to commit millions and millions and millions of dollars to make sure that the market goes up before the market opens. So it looks rosy. You get the breakout signals. You're above resistance. You've got volume, everything that you need to make a traditional technical analysis by decision, if you will. And then he says we'll move it up and then we'll fade it off the rest of the day. For the sake of the example, have you ever seen the markets be up first thing in the morning and then by the end of the day they close down negative? If you said yes, that is what he's explaining here. Let's continue.
Well, on a related note, there's so many more hedge funds today than when you were managing your hedge fund.
Right.
Do you think that does that exacerbate the moves, or does it make it tougher?
Well, you know, the hedge funds are positioned long short, okay, not just long like mutual funds.
So I've got to pause it right here to explain to you guys what he just said. He said hedge funds are positioned long short, not just long like mutual funds. Long short just basically means they can buy low, sell high, and buy back low. He said the reason why I paused that there is because here's a reality check. What the overwhelming majority of society does not understand is that by buying a stock, a mutual fund, by putting your money in any type, in my opinion, any type of managed account, and I don't care what the label of the account is, that company, not so much the individual financial certified professional who's speaking to you, but that company that person works for will put your money in a general fund, and guess what? Those monies generally go into mutual funds. Now, there's a whole other series that we can talk about kind of with that, but for the sake of this video, we will go ahead and refrain from that. So the overall point here is the big 8 banks and institutions give themselves permission to go long and short, bullish and bearish, make money as the market goes up and as the market goes down, but they force you to only be long or only buy low, sell high. That works to their advantage because they know the longer you keep your money in a managed account, the more money they will make from you, regardless of the market direction, because of the little F word in this industry known as fees. Oh, wait, it gets better.
So it's really vital these next 6 days because of your payday. You've really got to control the market. You can't let it lift. When you get a research in motion, it's really important to use a lot of your firepower to knock that down because it's the fulcrum of the market today. So I mean, let's say I were short. What I would do is I would hit a lot of guys with RIM. Now you can't foment. That's a violation of
foment.
Yeah, you can't foment. You can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't understand it. So that's the only sense that I would say this is illegal. But a hedge fund that's not up a lot really has to do a lot now to save itself. So this is different from what I was talking about at the beginning where I would be buying the Qs and stuff. Right. This is actually just blatantly illegal. But when you have 6 days and your company may be in doubt because you're down, I think it's really important to foment. If I were one of these guys, foment an impression that research in motion isn't any good because research in motion is the key today.
So what I'm going to do here is pause it there, and hopefully you guys are keeping up with what Mr. Cramer is saying. He says, first off, for the sake of the example, in 2006, RIM, ticker symbol RIMM, was the stock that everybody was focused on. And if you don't remember Research in Motion or ticker symbol RIMM, maybe you remember BlackBerry telephones. BlackBerry telephones were made by RIM. It was a Canadian-based company. RIM assumed that they had cornered the cell phone market. And if you follow the timeline, back in 2006, everybody had a BlackBerry until 2007, early 2008. The first generation iPhone was released, and then the shift of power happened. So again, coming back to the video, he says, hey, look, let's say you had a stock like Research in Motion because it's the fulcrum of the market. Fulcrum is an engineering term called the tipping point. So basically back then, and this changes all the time, but what Cramer is suggesting here is whatever RIM does, the overall market will follow back at this time. It's when this video was recorded. And so he says, so let's say that let's take a stock like RIM. He's gonna commit millions of dollars to make sure that RIM goes down, but he's gonna give some conflicting informations and make sure that the market goes up. But then he stepped in and also said, now you can't foment, you can't create yourself an impression that there's something wrong with the stock. But he also said you do it anyway, because that is the part that the SEC doesn't understand. And he basically just said it is blatantly illegal. All right. Here's the issue. It's not that the SEC does not understand it, is that they have a hard time proving it. All right. That's the problem here. All right. So check it out.
So, you know, you would hit this guy and that guy, and when you would see an offering, when you see a guy who's bidding, you'd wipe out that guy very quickly. And what I used to do was called, if I wanted to go higher, I would take and bid. And if I wanted to go lower, I'd hit an offer. And I could get a stock like RIM for maybe, that might cost me 15, 20 million, Annie, to knock RIM down. But it would be fabulous because it would beleaguer all the moron longs.
So I'm going to pause it right there. It would be fabulous because it would what? And I quote, beleaguer all the moron longs, end quote. Who is he talking about, everybody? With all due respect, he's talking about you. If you have bought into that philosophy of buy low, sell high, and all this other negative preconceived notions that the market's bad and things of that nature, he is calling you a moron long. Why? Long just basically means buy low, sell high. You can only make money when the market goes up. And if that's all you're after, he may have just insulted you. All right. But he also shared with an inside information. He says, look, if I'm trading with all this money from on the institutional side, and I want something to go higher, I'll take and bid. Now, inside Investing Made Easy's webinars, we also talk about how the market works in the relationship to an auction. And it's very, very simple, everybody. And if you're not familiar with an auction or have never been, maybe just a yard sale. Let's actually use that one. Let's use that example. If you have ever been to a yard sale, or if you have ever hosted a yard sale, you have become the market maker. So let's say you're trying to sell a lawnmower at your yard sale, and you put a price tag on there for $50. That is your opening bid, and that's what he's talking about here. He says, if I want something to go higher, I'll take and bid. So he'll take the lawnmower. He's got some more in reserve. He'll bid the price up, and that creates price momentum and curiosity and interest, and the price will go up. All right. So if you are hosting a yard sale and you have a price tag on that lawnmower, somebody comes up and says, how much? You say $50. Now, if they offer you $50 right there and there, then you just sold your lawnmower for $50. But usually people say, I don't know, I want to think about it. They turn away, and maybe somebody else who is at the yard sale hears that conversation, turns to you and say, hey, I'll buy your lawnmower for $50. And then what do you know? The person that just walked away turned around and says, you know what? I thought about it. I'll give you $50. And then the other person that just offered $50, he says, well, no, I just offered him $50. You can't do that. And then the original person says, well, I'll give you $55. And then all of a sudden you got a bidding war. Next thing you know, you step out, let him hash it out. And now you're selling the lawnmower for $80. All right. That's what he means by take and bid. And that's what we at Investing Made Easy mean, that the markets move just like an auction. You guys, the only reason why price goes up is because there's more buyers and sellers. The only reason why price goes down is because there's more sellers and buyers. So just as if you're at an auction or at your yard sale, somebody says, I don't want to buy that lawnmower for $50, and they're the only person there, but you got to get going on with the rest of your day, whatever the case might be. What do you have to do to entice this person to buy the lawnmower? Come on, it's not that hard. You have to lower the price. So ultimately, you negotiate and you sell the dang thing for $30. Does that make sense, everybody? And so that's what he means by take and bid, hit and offer. And he also used a gambling term called ante. they will ante up. They will ante up tens of millions of dollars. Why? Because it's not their money, and to them, it's like gambling. To us, it is not gambling because we're doing things very systematic, knowing where high probabilities are. But again, he just called everybody who's in the buy low, sell high mentality morons. So you might want to pay attention to that. Here we go with the rest of it.
Who are also keying on research and motion. So
There's a lot of that going on today with
we're seeing that.
absolutely.
That's, again, when your company's in a survival mode, it's really important to defeat research and motion and get the Pisanis of the world and the people talking about it as if there's something wrong with RIM. Then you would call the journal and you get the bozo reporter on research and motion, and you would feed that there's a Palm's got a killer it's going to give away. These are all the things you must do on a day like today, and if you're not doing it, maybe you shouldn't be in the game.
Okay.
He says these are some of the things you must do, and if you're not doing it, maybe you shouldn't be in the game. Look at his face here, everybody. By the way, this kid over here in the white shirt, if you're watching his body language, it tells the whole story. He can't believe the crap that's coming out of his mouth, and I would assume that this kid over here on the left has some type of financial degree or maybe even economic degree or something like that. But anyway, what does Cramer mean by the Pisanis of the world? What he means is the news reporters. Have you ever heard of the gentleman by the name of Bob Pisani? He is a commentator for CNBC, and he is on the floor of the New York Stock Exchange every single morning. His colleague, Rick Santelli, is on the Chicago Mercantile Exchange every single morning. So what Cramer is saying here, again, now he's talking to the big institution side, not us on the retail. That's why we are sharing with you how the market is manipulated. All right. So he's basically saying, hey, I'm going to make up a fictitious story that there's something wrong with RIM, research and motion, because if that's the stock that everybody's focused on, and we can make up a story that creates panic, but then also pre-stage a whole bunch of sell orders and start driving the price of RIM down, well, then they're going to trap you to make you erroneously think the market's going to go higher first thing in the morning by driving the future prices higher, but all the while they are sneaking in the back door, driving RIM down. And so people following traditional technical analysis sees a breakout above resistance with high volume and anything else that they want to justify taking a buy signal with. They buy. These big boys and girls are selling, and they use the news media to help promote that. Now, by the way, the news media is an innocent bystander here. They get paid for selling advertising space. And so the overall point, not to get too far off into the deep end here, is you don't bite the hand that feeds you. If you have a company paying you millions of dollars to run a 30-second commercial, you're going to deliver the ad that you've been paid to run. It's common sense. But what does he mean by the journal? He says you get the bozo reporter over at the journal. And basically, in a nutshell, he says they don't care. They just want the story. They don't care if it's right or wrong. They're talking about the Wall Street Journal and any other news organization that may be out there. All right, so let's continue.
Another stock that a lot of people are focused on right now seems to be Apple.
Yeah, Apple's very important to spread the rumor that
spread the rumor.
Both Verizon and AT&T have decided they don't like the phone.
Right.
That's a very easy one to do because it's also you want to spread the rumor that it's not going to be ready for Macworld. And this is very easy because the people who write about Apple want that story. And you can claim that it's credible because you spoke to someone at Apple, because Apple isn't and it doesn't.
Right, they're not going to comment. They're not going to say.
So it's really an ideal short. And I would, again, if I were short Apple, I would be working very hard today to get that.
So listen up right here, everybody, because he's going to summarize over the last 4 minutes and 10 seconds of this video what he's basically talking about. All right. So I'll come back in and add some commentary afterwards, but listen up here.
And the way you would do that is you pick up the phone, you call 6 trading desk, and you say, listen, I just got off the phone with my contact at Verizon. And he has already said, listen, we're a Lucky G house. We're a Samsung house. We're a Motorola house. There's no room for Apple. They want too much. We're not going to let them in. We're not going to let them do what they did to music. And, I think that's a very effective way to keep a stock down.
Right.
I might also, by the way, because the stock at 84, 85, a little bit of capital, you go buy some January 80 puts that makes it look like there's going to be something going on. So maybe you give Morgan an order to buy 1,000 Jan 80 puts. Then you go position limit with, you use a firm that doesn't know what the heck it's doing. Maybe you go to UBS for puts, and you just kind of create an image that there's going to be news next week, and that's going to frighten everybody.
Right.
Then they all go out and say large put buyer UBS. And then they call Pisani again. You have to use those guys and say, listen, I see a big buyer of puts, and I'm told that it's SAC. You would do that too, and these are all what's really going on under the market that you don't see.
Right, nobody else talks about it except you.
What's important when you're in that hedge fund mode is to not do anything remotely truthful.
Did you guys hear that? Even though he's talking about hedge funds, this is the entire financial industry. He said what's important when you're in the hedge fund mode is not to do anything remotely truthful. I wonder why.
Because the truth is so against your view,
right,
that it's important to create a new truth, to develop a fiction. And the fiction is developed by almost anybody who's down like 2% to up 6% here. You can't take any chances. You can't have the market up any more than it is if you're up 6. Because starting Jan 2, you'll have all your money come out. So what would you do if you're in that situation and you feel like you're desperate? Is that you would do these actions.
So you're
Now listen up here, everybody, to this next question this kid is going to ask him. The reason why I'm pausing it here is because this will go to question your entire belief system that more than likely you have believed your entire life to no fault of your own. But listen to the question and listen to the response here. And this is why people are flocking to our webinar services at Investing Made Easy. Listen to this.
You're talking about the mechanics of the market.
Well, mechanics are much more important than the fundamentals.
Oh, okay, well, but in terms of the fundamentals, you've been writing about how you think.
Who cares about the fundamentals? Research in motion just blew out the court.
Right.
But look what people can do. I mean, that's a fabulous thing. The great thing about the market is it has nothing to do with the actual stocks.
Right.
Boom. Did you guys hear that? He said the great thing about the market, it has nothing to do with the actual stocks. Now, let me back it up. This gentleman in the white shirt said, hey, now you're talking about the mechanics of the market, the technical analysis, reading the charts. What about the fundamentals that every person in society, in my opinion, has been brainwashed and led to believe is the most important? And Cramer straight up just told you, who cares about the fundamentals? The nice part about the market, it has nothing to do with the actual stocks. Listen here.
Right.
Now, look, over maybe 2 weeks from now, the buyers will come to their senses and realize that everything that they heard was a lie. But then again, Fannie Mae lied about their earnings for $6 billion. So,
right, and Bristol Myers lied.
It's just fiction and fiction and fiction. And I think it's important for people to recognize that the way that the market really works is to have that nexus of hit the brokerage houses with a series of orders that can push it down, then leak it to the press, and then get it on CNBC. That's also very important. And then you have a kind of a vicious cycle down.
Right.
And it's a pretty good game. And it can be played. You can pay for a % or two.
Right, and then do you get long before Macworld and the expectation that the iPhone is going to be good? Right, and then you go back, flip to the long side.
You certainly got to use the other side.
Interesting.
Yeah,
So I'm going to pause it right here, and we're going to end the video here because of the rest of this video, they talk about the cell phone industry. But the gentleman in the white shirt, Aaron Task, he says, so do you get long before Macworld and everybody else? Which basically means a couple weeks down the road when everybody else comes to their senses, meaning you come to your senses and realize that everything that they heard was a lie, the price has already gone down. Cramer has already shorted the market weeks ago, and not only that, but the financial industry itself. I just said that because that's the example that we're looking at. But the financial industry has already shorted the market. So by the time the general public catches wind that everything that they heard was a lie, and or as their stop losses are getting hit, or that you can't stomach it anymore, and you're cutting your losses, and you're pushing the sell button to get out for a loss or hopefully break even or whatever the case might be. The point is, when you're hitting the sell button to get out, they are buying back their position that they sold weeks ago, and they're making the profit in the middle. So if they sold something for $50 and it drops to 40, and somebody sells their stock at 40 and says, I can't take it anymore, just let me get out, well, then you lost the $10 a share, but they made the $10 a share. And so Aaron Task here, the gentleman in the white shirt, says, so do you get long? So a couple weeks later, do you start to buy low again when everybody else comes to their senses? And Cramer says, and I'll paraphrase, he's like, yeah, I'm not an idiot. You're the reason why a few weeks earlier that the price went down. So when everybody can't stand the loss anymore and pushing the sell button again, these guys are buying it, and there again starts the cycle all over. And sometimes people wonder why they can't seem to get ahead in the overall market. So let's go ahead and wrap this up. Hopefully this was very educational for you, very enlightening. We certainly do hope to see you in our next Investing Made Easy webinars. Check out our monthly subscription services, and if it's a fit for you, great. If not, we certainly would appreciate your referral, and we will see you guys shortly. Until then, thank you very much for your time.